But if you're expecting silver to double and then double again and double again and do all that crazy stuff, it has a much higher likelihood of doing it once gold is able to outperform SPX, because you're going to need all that money leaving US equities and going some of it into silver, all that money printing, right? All that M2, all that money, that's what drives the price of silver,
So
gold.
yeah, it looks like it's there, especially with Nvidia having played such a huge role in the run up. It's likely to play a role in the run down, and it's so far stretched past its moving average that, like you say, the setup is really there. But Patrick, staying on this, in a recent post, you stated that there's really zero reason to be scared of a bear market. What are you seeing there? Like, why
Yes, okay.
is that? Because does that tie into your thesis that if it does drop 30-40%, that is what's going to propel the investment managers to start moving towards the precious metals?
Look, what I meant by that, and that's why, guys, we have the website there, because we can nuance all that. What I meant is people should not be scared of a possible bear market or 30% crash, because I'll show you here. Like, let's say the SPX. This is the monthly chart for the SPX. Look, before we have these crashes, look, these 40% drops there, they don't. 50% drop here for the SPX, or whatever, the 2008 drop for the SPX, they don't happen like in 1 month, right? They happen over periods of months. There's retests. Like here, I'll remove this for you guys. Look here, the SPX started faltering. It broke down that momentum, that rising trend line. Look, it did a retest here in the 2000s. You know, there's a back, and then there's a retest here. You'll be able to see, look, before the monthly charts start rolling over into a multi-year bear market, you will see the daily chart fell first. And so that was the essence of my message is, if you know chart trading and you do multi-time frame analysis, right here, I'm putting back the SPX on the daily chart. Here's that chart. Look, the 2000s, I'm going to go back to the 2000s. Here it is. So here's the 2008, it goes up, up, up. Look at that topping structure. It takes time to play out. Sometimes you'll have a hard drop, a 10, 15% drop, right? You have a huge topping structure. So before you have that huge fall that goes down forever and ever and really, like, scares everybody, daylights out of everybody, we're going to see it on the daily chart. So that's why you shouldn't fear a bear market, like a multi-year bear market, because if you zoom in on the daily chart or the weekly, you'll be able to bail like way before that happens, right? And even if you bail, and let's say you do bail here, let's say you thought back here, it was here, that was the top in 2007, it bails and it continues upwards. Well, you could still get back in, because as soon as the bearish technicals resolve and that bull flag resolves, then then you get back in. But every time it falls, every time you start losing here, you start losing support, and you start losing longer term support. You have these opportunities to exit, right? We're not hedge funds where we're stuck and we need approvals of the committee to decide if we dump or not, or we have to offload our billions over months, because it's like pension funds that have rules. We're mobile. We're like small guys. Like, we can move our capital like millions of dollars, like much easier than these big guys. So let's zoom into today to give some value for your viewers. Look. Yes, it's starting to falter, but right now I could draw this line and I could accept that I'm bullish neutral SPX right here on the daily chart until I start losing this trend line, right? Or eventually this one. And I'll just help you guys by drawing a roadmap. So, this could happen. It could bounce up here. Let's say it could lose that one, retest here, and then it falls. But look all this time I have. We could have a full failure of the SPX, but it could just be next year. It's going to take time for this thing to really roll over, unless you expect it like really, because we always hear the doomsayers. We always expect it to do that, right? You see these guys do these charts and with a line down, but history's shown us that there's so much money still flowing into stocks that it's not going to do a 40% drop like that. It's like, those are outlier events. It's more likelihood that it drops hard. Planned money that was already there in the pipeline of buying, all those pension funds that already they'll still buy,
Right.
eventually on their next meeting, they'll say, okay, well, we're not going to buy as much. We're going to sell and stuff like that. So that
It would require, I mean, when you think of all the employees that have this auto, pay into their
yes,
401k, everything's just on autopilot. And so it would require a mass unemployment event to happen pretty quickly for all that to stop.
yeah, exactly.
Yeah.
It's not like we imagine in our heads. If I give you a price target of $80 for silver, you're imagining a straight line from here to there.
Right.
Or if I give you a bear market, I say, oh, U.S. equities, they lost 80% price in gold in the 2000s. But in your head, you're imagining from there to there. That's not how it played out.
Right.
It's
And it
not.
played out over a long period of time.
Oh,
So
long time.
let's shift over to residential real estate.
Ooh,
Okay. So Patrick, the median house price in the United States has become unaffordable for the median wage earner, and especially those who are younger and they're early in their careers. What is your technical analysis pointing to for residential real estate prices?
all right. All right. Let's share a chart and I'll share you guys. It's a post I did for members. Members, please bear with me there as I share this with Gary's audience. But here I did an analysis for the median sell price of houses sold for the United States. So it's not it's just the median price, right? So if it's median, people might relate to this. A median price in the States is worth 400K. Maybe Gary, you could tell me like a 3-bedroom house, a couple of bathrooms, single garage, double garage. I guess that's a fair price, right? 400K for that.
I guess it depends on location.
Yeah, exactly. But that's the stats. Here I have the stats since 1967. So, and this is a quarterly chart. U.S. stock market housing prices, the median price up above the 12 quarter period, 12 quarter moving average, the 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 12 period, the 12 quarter moving average. Sorry, guys, my brain's thinking in French and I have to talk in English. It's weird. Here's my 36 quarter moving average. So the real estate in the States have been pretty healthy for very long periods of time. And when people say crash, well, at worst, what it's done, it's reconnect. Here's a 2008 crash, right? The 2007 early, the real estate went down and sideways to reconnect with its 36 quarter moving average here. From 2015 all the way to 2020, it kind of went sideways. So I'll zoom in here for you guys. Here are the peaks we had in real estate, 2006, 7, sideways move all the way to the bottom. You see, way before the 2008 crash, the real estate was already cooling down, right? Before, you see, it didn't happen overnight. People, oh, the 2008 crash, people, or the 2009 crash, people remember that. Like it went down like that overnight. No, it started gradually going sideways, neutral, then down. Here we had a peak, 2017, 18 real estate went sideways, let the moving averages catch up. Here's so here we had these surges. 2012 surge in real estate, 2020 surge in real estate. Right now, all that's happening, Gary, is we're in one of these periods where real estate has topped the median price, and now we're letting the moving averages catch up. Will it be violent? Will it be sideways? Right now, it's lower highs and lower lows, so it's in a downtrend. It's just a question of when does that thing start turning back up? But if we look at all the other elements, that, the yield curve uninverting, the unemployment tracking up, right? Gold, like when you look at all the weight of evidence, real estate is not out of the woods yet. On the recovery phase of this, once like the bubble has been popped, then when the spigots, they start printing all that money and stuff, then it's gonna put a floor under this, and then we're gonna have another rush. So for me, the real estate, the low watermark right now is recapturing that 9-year moving average, which is about a 355K, but it's still going up, right? So by the time we reach it, it might be at 370K, 380K. So the median price, it's topped 420K, starting to go slow down to recapture that moving average. So I don't know if people want to buy houses right now. They're not at the peak, but they're probably not at the bottom yet, right? It's once you close above this descending trend line here, these lines here, and the momentum here breaks out to the upside, that's when you better get on the train, because we're having another surge in real estate prices, but we're not there yet. We're in the cool off, And once you're at the cool off, that means neutral, and you're at risk of having these, these rug pulls for the real estate.
Interesting. So let's turn over to gold. In your gold chart roadmap, you headline it with it's an opportunity like this does not come along very often, and the massive rocket ships knew the way. Would you walk us through your gold chart analysis?
Yes, let's do it again. All right. Share screen. All right. So I'll just put the gold chart right here for you guys. Gold, I'll put on the quarterly, remove indicators, and put the chart back here. So essentially when I did that chart, we had this pattern right here. It was a megaphone pattern where I think the price was right down here. I think it's right here. I'll just show you guys the original. Where am I? Okay, here it is. Okay. So look, again, it's not to say I called it or not. In hindsight, we know what happened, but it could have not materialized that way, guys, right? It's not 100%. It's not, it's not binary. It's nuanced, but we know that if it breaks upwards, what you have to understand is it's doing a higher high. If it breaks upwards, that means the higher low is behind you. But guys, that's an uptrend. So if I would have put a moving average on this, you would have seen that this thing's trending above a moving average. It's mathematical, it's objective. So this is the setup. I put the rocket ships because I love clickbait stuff and it makes it fun a little bit. But this is what happens when you break out above a huge base, you do a higher high, again, uptrend. The market participants are pricing this higher and higher. And what happened after this resolved upwards? Well, what happened was, where's my gold chart? Here. It just went upwards, right? So it could have, yeah, it just went upwards because from the probabilistic aspect, the probabilities were that once you do higher highs, then you're in higher lows, then you're just an uptrend. And this, on a quarterly adjusted basis, that's probably my classical charting measured move right there. I don't know if you were going to ask me what I thought the target was, but we're in the range. From a linear, if I would have done gold on a linear chart, we have already reached its target. It was a 2400, 2380. Like we've already reached that from a linear scale perspective. From a log scale perspective, this is my greedy target. So right now there's still room for gold to go up all the way to 2700 in that uptrend, right? And look, it's a quarterly chart. It doesn't mean
then you expect it to consolidate for a period of time.
Yeah, sure, exactly. So these halfway flags, they happen all the time, and that's a pretty important halfway flag, right? So let's say here I'm in the 2000s, up move. Then after that, sideways flag, up move. There's a aggressive sideways flag here. Depends how you draw it. Up move, sideways pattern. It's not some. And then after that, it just repeats and repeats. Sometimes it overextends.
So this is a similar pattern that you're expecting us to be in at this point.
Yes, and especially with the length of it, the consolidation of it, and the resolve upwards. It's like the bigger the base, the higher in space, because all the previous bag holders, the people that gave up, all the sellers, the built-in sellers are not there anymore, because that's the power of a base is all these people that got trapped here that bought at the top. Over 5-6 years, they sold. Tax loss, whatever reason, they give up. You insert the reason why you want to sell something. The miners suck. I'm out, but once all these people are exit, then once the buyers come in, there's that selling pressure is not there anymore because nobody's in the red anymore. And why this stops eventually is because all the people that did buy in this consolidation here, they're going to want to take profits, right? There's like a natural elasticity before, because people, they see, oh, there's no overhead resistance to the moon. People will want to take profits eventually, right? And usually it's when that move, there's a measured move there. When you're getting close to it, you have a higher likelihood that you're closing in on your target there.
So do you have some targets for the miners?
Yes.
GDX, GDXJ, any of those?
Look, it's so weird because the miners, if I look at the indices, they aren't like, it's like the ASA chart that I showed you. Let me just put that candle chart. I'll put on the monthly. But there's some miners, guys, that are much better than the indices, right? There's some miners that track gold way better than the ensemble of miners. But oh goodness, 1, 2, 3. That looks like a breakout for JDX. But remember, these breakouts, you got to take them with a grain of salt until gold breaks out versus SPX. That's when these things really rocket upwards. So if ever this thing really properly resolves and we do close and really we get out of this congestion area here, then my initial target would probably be a measured move there. Yeah, we're going to probably go all the way up here. I like looking also at distance from moving average to spot. So here I know that previously the miners were able to distance 71% above the moving average before slowing down. And I'll just put my measuring tool for you guys here. Where is it? So here's my red line. Here's my moving average, 71%. About here. I'm going to put for you guys just the curve, just to show you guys what I'm showing you. So here, the red line is the 3-year moving average right there. If the price is above, that 3-year moving average will incline. If it goes up faster and faster away from it, it will incline steeper and steeper. And that's what you see here. That's the distance from the 3-year moving average. As that going up is I'm distancing myself. That's what you want. You want price close to the moving average and not just staying a certain amount above the moving average. You want it to distance. You want capital flows to override and drag that moving average exponentially up and up. So here's my distance. I know that once I'm 71% above my 3-year moving average, I will have a high likelihood of being in a FOMO zone, in a selling to strength opportunity. And look at that. If I just add it on top, it matches pretty much my target area here. So that when I combine those two elements, it's like it's like a scatter chart there. In chart trading, it's not just I did this classical TA technique. Oh, I have my measured move. That's it. It's set in stone. No, you use that technique to get a target. You use that another technique to get another target. And it's that ballpark. If you get multiple targets in the same area, then you increase the probabilities of that target being less greedy and more probable.
So this is your 12 to 18 month view, if I'm not mistaken. I don't want to put words in your mouth, but is this your 12 to 18 month view on where you see the miners going?
2025. Well, yes. So the caveat is this has a higher likelihood of happening, of us getting above this once gold breaks out versus SPX. This has a much higher likelihood. So I would probably put like my move would start probably here.
Mm-hmm.
But once you start closing above, that wall of resistance here, previous support turn resistance, then indeed the trajectory will be
swifter.
Because it's something called what we like calling a reverse symmetry move. And I'm just going to highlight it for you guys. It's fun. We're doing TA. I love doing this. Sometimes, pre-constructed charts, they're fun, but going through the process really helps also for somebody who's a neophyte or like a noob in chart trading says, okay, that's why he sees that. And you'll see often these reverse symmetry moves, these angles. Here, I'm going to put an angle on this one. So that's a 64-degree angle going down. And often you'll mimic that 64-degree. So that scales in time depending when we have the breakout, right? Mm-hmm. So here I have a 62. Wait, I'm just going to lower it. 64. Okay, 65. So that also helps you guide the energy that went into that base is often also the energy out. So this will help you guide where to expect to reach that target. So it really helps when you have a time to reach, because instead of you thinking I'm going to be a millionaire overnight, which you should never think that's like, it makes you oversize, overposition, over risk. It's okay, look, this is going to be, this is a monthly chart. It could be all the way to 2026 by the time, I reach my target. That's my game plan, as long as it trends upwards above that 3-year moving average, I'm good. I'm doing higher highs, higher lows. It's fine. So that would probably be the roadmap. Of course, it could be more aggressive, Gary, like it could rocket upwards, but this would probably be a much safer roadmap there. all the way.
Fantastic. All right. So, Patrick, let's move over to silver here. The narrative and expectations around silver, it's very bullish. Silver's needed for AI data centers, EVs, advanced weapons, solar panels, and the electrification of everything. And that's just to name a few of the big ones. All of these are creating increased demand that has pushed silver into a supply deficit for the last 4 to 5 years. You recently posted that a bull market equals price trends upwards. A bull era, which you alluded to earlier, equals price trends upwards, but also outperforms the S&P 500. Would you share with us what the charts are informing you over silver?
Yes. Look, okay. I don't want to, maybe one day I'll debate a fundamental guys, but I care nothing about what silver is used for. I care nothing about that there's a supply deficit. I don't care about that because for me, that's what I think I know. That's a supply, a constructive fundamental factor for silver price going up. There's probably an inverse rationale or narrative or story to justify why it won't go up. It's like uranium. Why the hell? Sorry, why is uranium going downwards? The fundamental hasn't changed since 2020. Why is it going down? It just leads to a lot of confusion. So what I'll do right now is I'll put here is my capital rotation chart, guys. Just gold versus SPX. I'm just going to remove drawings, reset chart. I'll put on monthly. Okay, so here's my capital rotation chart. And guess what's going to happen when I overlay silver on top of this? Log scale. Look at silver. When you had the capital rotation here, when gold was breaking out versus the stock market here, silver bottomed and went up in an uptrend. Here, well, it kept going up for a very long time. Here in the 1970s, capital rotation event, look at that silver tracking those capital flows, tracking gold versus SPX to almost to perfection. Look at the 2000s. I'm going to drag that down here. Same thing here. Gold outperforms SPX. Look at silver, what it does. It goes all the way up together. So right now, even if and of course, because silver's price in fiat, nominally, it will have a structure that will look different than something that's oscillating within a range, right? Like gold versus SPX, you remove the fiat denominator, right? So the denominator for SPX, or in this case, the denominator for gold here is SPX shares. So it creates more of an oscillating type of chart compared to fiat because they're the destruction of purchasing power. They're just adding zeros, right? So of course, silver is gonna, it's gonna look better on its fiat denominated chart, but it will really go up. It will look even better on its fiat denominated chart once the capital flows go up. So silver, you could make a case that it's already in a bull market. So bull market price trending upwards on its own chart, right? It broke out here. Let me just remove the angle here. It broke out even here. So now bigger patterns, silver's uptrend, right? Higher highs, higher lows. It's fine. It's a bull market. It's in a bull market on its own, silver, no problem. But the crazy gains it does whenever somebody puts $70 silver, $170, $200, $500 silver, these crazy gains only happen once gold is able to outperform SPX. So that's the bull era part of it, right? Silver's doing great. It's fine. But if you're expecting silver to double and then double again and do all that crazy stuff, it has a much higher likelihood of doing it once gold is able to outperform SPX, because you're going to need all that money leaving US equities and going some of it into silver, all that money printing, right? All that M2, all that money, that's what drives the price of silver, gold.
Yeah, so this has been a constant theme today, and it's interesting, the shadow that the S&P 500 has cast over commodities has been enormous, probably bigger than any shadow in history, and there's been some really large ones. So, you have people who just want to keep putting their money into Nvidia, into Meta, into Apple, etc. They want to keep throwing it into the S&P. They're moving it into some other areas of the S&P, but it's a significant, out of every dollar, I think it's well over 30 cents or more is going into tech. It might even be higher. At what point does that shadow diminish, get smaller, and money starts flowing? Does it require a massive crash, or does it require just sideways trading for so long where these investment advisors start to say, look, we're not getting anything out of this. It's time to start shifting?
It's that 40% drop there. Like these capital rotation events, they happen when the market loses 40% or starts losing 40%, and market participants front run that and say, okay, it's like when the 2001 crisis happened, or the dot-com bubble, gold didn't start turning up when the markets lost 40%. It's about a third way through, they said, or halfway through, okay, that's it. It's deep enough. That thing's going to keep tumbling down. Money started flowing to gold and to silver. Like, they don't need to wait to the bottom. Same thing in 2008 crisis. Gold bottom way before the U.S. equities tumbled, right? Gold bottom, like on a yearly chart, you can't even see the low in gold in 2008. That's how powerful, like that's how fast it recuperated and went up. But the markets, the aggregate of market participants have to be convinced that whatever 15, 20% correction that's happening in the stock market, that's not it. Once they realize that next correction will not be a correction and it will lead to a bear market, that's it. That's it, Gary. We're golden. I'm going to start buying all these miners like a madman. And that's it. That we'll start doing our victory dance for the next 10 years, like
well,
your
all right.
gonna...
So that's when you're going to start buying for the next 10 years. But Patrick, are you invested even partially now in gold, silver, and miners? Or are you waiting 100% for the evidence of this capital rotation event to occur?
You don't need to wait for it. It's there's some miners, like I'll drop a name like Aya. Aya Gold. Aya is like, that thing is just went up. I'm not saying it's a buy right now there, but we played that before because itself, that chart, I could do a ratio of Aya versus SPX. I could do a ratio of Aya versus gold. If the chart nominally is going up and I'm outperforming SPX and outperforming gold, I might not need to wait for the aggregate of the SPX to break down versus gold, right? There's some front runners like Wheaton, AEM is looking very close to turn breakout. There's these streamers that track better the gold. Look, this is my take on the miners. The indices like GDX, ASA, Huey, whatever the aggregate of them, they track pretty much gold versus SPX. The weaker miners, the terrible ones, they track gold versus PX, but like really, like they can't even front run that thing. They can't. They really need that extra slosh of money, that money that goes in everywhere and everybody, like even the crappy miners with horrible management go up, right? Because that's what's going to happen in a bull run. The crappy stuff's going to go up as much or even not more than the good managed company. But the good miners, they track gold versus inflation. Sometimes just gold breaking out versus inflation, like in the spectrum of evidence, that's already, and gold is breaking out. Gold is an uptrend versus inflation. So that's opening the gateways for the better miners in there. So there are probably 5-6 miners on a handful of them that are great, right? But on the whole, when you compare to the ASA chart, the bulk of them will require gold showing more teeth versus SPX. But there is definitely some miners like Dundee. I don't know. You must know them, right? It's your business there. But there's a whole bunch of them that are front running this, that are doing good. And we played them on the website. There's like no issue there. But we know that whatever Aya or these good companies have done in the past year or two, they're going to do much better once gold breaks out versus SPX. It's crazy. So even if that thing went up 50, 60%, the good ones now, they'll do so much better on the other side of that capital rotation event. People think I'm bearish miners. I'm not bearish miners. I'm telling you that they'll do better later. And I don't know why that's hard to accept. It's like,
yeah.
And most of the gains in bull runs are done in the last 20% of it, the run. So knowing that, it's like, why would I know you want the itch, guys. You want the itch, you want to gamble a little bit, but the bulk of the gains happen when all that crazy venture capitalist money slushes in later. We're just so early. We haven't even started the ball game yet for the miners. It's like, it's bonkers.
Well, I appreciate your viewpoints. I really do. This has been a wonderful conversation. Before we wrap up here and I ask Patrick our final question, I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us. Also, positive that you've enjoyed this conversation with Patrick as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. It's now time for our Golden Nuggets segment. Patrick, let's discuss risk management. Based on your technical charting and fundamental analysis, what is your risk management strategy for trading an asset?
All right. Well, look, risk management is always about understanding the risk versus reward. So whatever my entry point is, I don't know, could I show my screen and show a fast?
Sure. Yeah, please.
I'll just show you because this is very important, guys. So let's say I do have a chart. We just talked about AYA, guys. So I'll show you the AYA chart. And here is my hollow candles. So let's say here I have a breakout. That's how I manage, or even here, there was another one here. Okay, so let's say I do have a breakout. From a chart trading, what's great about chart trading is I actually have price points where I know that once I break out, that resistance becomes support. So if I put a sell stop below it, and then I have wherever my target is here, I'm able to establish a risk versus reward profile. So I enter here above the breakout line, my sell stop's down here, that's 1. And then wherever my target is, it's a multiple of that. So I have, let's say, even a 3-to-1 risk to reward. So every time if I win this 50% of the time, every time I will win 3. And the other time, let's say it's like I'm a coin flip kind of trader, and then I lose 1 on the other time, I net +2. So I'll make money over time, right? So if ever I have a risk to reward 3-to-1, 50% of the time I lose 1, 50% of the time I win 3. And then that means I net 2 over long periods of time. It's mathematical. That's what professional chart traders do. It's always about getting an edge. And then even if they're right 50% of the time, then they're fine. And the other part of it is money management. Never bet more than, I don't know, here's a lot size of 2%, but you could put of your NAV, let's say my starting NAV is 100K, then I won't, if that thing goes down to my sell stop, I won't lose more than 1% of my NAV. I'll lose $1,000. And if it reaches my target, so even if the price goes up, from my entry 60%, it's not my portfolio going up 60%, guys, because that would imply I bet everything. It's that my portfolio will go up 3%, right? Because my risk reward, I lose 1%. And if it goes up, I win 3%. So my NAV went up 3%. This definitely caps my updraws. I'll have less clickbait type of returns, but it also protects my NAV, because we know that if we're wrong, recuperating the NAV, if you go down 50%, you have to go up 100% to get back to break even. 100%. Right. It's over. People go on tilt when they lose 50% of their NAV, and they start betting on anything, and it's practically guaranteed to go down to 0. So protect your NAV and always play that mathematical advantage you have there with the charts.
I appreciate that. So Patrick, thank you for coming on to the Metals and Miners podcast, for being so generous with your time and analysis and ideas. It's been incredible to spend the time with you. Would you please share with the viewers any important message you want to leave with those tuning in, where they can learn more about your work and how they can connect with you?
Well, of course, like a Bat Chart Swan on Twitter, I post a whole bunch of stuff, but like you saw, sometimes, I put a tweet out. I'm a French speaker, I'm bilingual, but sometimes, you don't nuance it better. So northstarbatcharts.com, guys, go check it out. It's the website I have with Kevin Wadsworth, North Star Charts. You might know him on Twitter. We have a 50% deal right now. I think in a few days it'll expire. So, if you want that, talk to us. We have quarterly live Q&As. We go through all this stuff there with our members. If you like what you heard there, I think that's the place for you guys to hook up with us there.
Wonderful. I will put all of your contact information up on the screen, everybody, and links in the description so people can click through. Everybody, if you're not following these guys, you really need to. They post relentlessly with charts and information and data, and they back it up with commentary and Q&A and a lot. So yeah, I mean, I've been following them for a couple of years now. I really appreciate their information. And you know, they're trying to help the community, the metals and mining community. So get connected with them. I look forward to having you back on, Patrick. Thank you for being here with us, and everybody else, thank you for watching. And I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us.